Thank you, Ryan, and thank you, everybody, for joining us today. We believe very much so that an informed investor is a good investor. And so we're hoping to just share some data with you today that maybe put some of the election rhetoric into context and just gives you a perspective to look at. And so we're going to start off by talking about the presidential election, but we're also going to talk about the race for the House and the Senate at an aggregate level, because that actually does influence things. As Ryan said, part of what we'll talk about today, and a big part of what we'll talk about today, is what the result might mean from a tax perspective. And that's particularly relevant because the current tax code is slated to expire at the end of next year, and whoever's in office is going to get to have their fingerprints all over whatever comes next. And so we asked Cliff, if we are investment analysts, to look for something humorous to start our presentation. And he came up with this. And it actually is very relevant in that there are 7 states that are likely to determine the outcome of the election. That's not to say that your vote doesn't matter if you're in one of the states that is not one of these 7. One of the first things that Ryan and I would encourage you to do is vote. You have a voice, use it. And we're fortunate to be able to live in a country where we're able to vote and help have an impact on what the results will be. If you're not familiar with the 7 states that are being considered swing states for this election, they are North Carolina, Nevada, Georgia, Arizona, and then the blue wall, which is Pennsylvania, Michigan, and Wisconsin. And I'll talk a little bit more about those in a moment. But as we head into an election, any election, there are effects on markets that we should expect. Number one, it introduces uncertainty into markets. And as many of you have heard me say, the market does not like uncertainty. And what that leads to is it can lead to a period of perceived risk. But there's another side of that coin that I don't want you to lose sight of, and that is perhaps some opportunities. The policies that are advocated by whichever party ends up winning the White House, or if they actually end up with control of the House and Senate, can really bring certain initiatives to the forefront, and that can bode well for different industries. It certainly creates the potential for market volatility. That goes hand in hand with the uncertainty. And typically, you'll see that. And I've got an interesting chart that kind of quantifies that increased volatility that we'll look at in a few moments. But it has a tendency of building into the election, and then it dissipates fairly quickly coming out of the election, barring any kind of non-election related catalyst. There's certainly policy uncertainty. If you are part of the executive management team for a Fortune 500 company and you're thinking about any one of a number of strategies, perhaps building a new production facility, whether you're expanding a particular division, making an acquisition, refinancing your debt and recapitalizing your balance sheet, all of these things kind of get put on the back burner, waiting to see, okay, is it going to get better or worse for any one of those initiatives? And so sometimes you see that uncertainty, that policy uncertainty, ripple through into the decisions that corporate America is making. And that impacts medium and small size businesses as well. And then, of course, the changes to the tax law that we've already mentioned. So as we continue with our conversation, there are several policy areas that voters are likely going to be paying attention to. And those will be trade and investment, immigration, energy, defense, healthcare, housing, and then the fiscal, tax, and regulatory policies. If Ryan and I invested the time to get into each of these policy areas in any depth, we'd have you here for hours instead of an hour. And so we're not going to be able to do that, but just be aware that when somebody goes into the ballot booth to vote, one of these issues, or maybe an issue not listed here, is likely primary in their thinking, and that can largely influence which of the candidates they favor. So let's talk a little bit about the election. I'm going to start with the race for the White House. And so when you look at President Trump or Vice President Harris, and you look at their policies across fiscal, trade, immigration, and regulatory policy, you're really looking at different aspects of that could help or hurt a variety of categories. And so I'm not going to get too bogged down into this, but just notice that as it relates to treasury yields or think interest rates. Now, this isn't the Fed. Neither Trump nor Harris will really have a direct impact on the Fed, but it certainly has an impact on longer term treasury yields and the bond market in general. And so there are some of Harris's policies that might argue in favor of higher yields. Some might be lower, some more ambiguous. And the same thing is said, it can be said of Trump. Looking at the US dollar, again, the various policies are stronger, weaker, or neutral for the US dollar. Trump a little bit differently. He's got a couple of policies, both trade and immigration, that are likely going to result in a stronger dollar, more neutral on the regulatory and fiscal policies. And then the other, I think, three categories that we want to look at very quickly are US stock returns. And so this is one that starts to speak to me as an investment guy. And one of the things that I want to point out is if you look at these different categories, you see higher, neutral, positive, and neutral for Harris, and you see higher, lower, negative, and positive for Trump, which is to say, no matter which of these candidates wins, you might still end up with a favorable stock market environment. In fact, the popular belief is generally that Republican presidents are better for financial markets. And I'll share some data with you later that kind of make the point. That's not necessarily the case. It's going to be dependent. And one of the points that I hope you take away from today's conversation is the election important? Absolutely. It's critically important for the future of our country. Is it important for the market and the economy? Yes. But are there other things that are also going to impact the strength of the US economy and market returns? Absolutely. We'll talk a little bit about that. But at least from these two candidates' perspectives, you can see both of them have some policies that would help and some that might weigh on markets a little bit. Same thing true for non-US equity returns. Kamala Harris's policies are generally pretty neutral, as are Trump's policies. Kind of dependent upon tariffs and how they get implemented, but that remains to be seen. And then also gold, look like both candidates are kind of neutral to maybe slightly higher impact on gold pricing. So forgive me, I know there was a lot of content on those two slides. I wanted to at least hit on them so you kind of have a sense for how policies impact. But let's talk about the election and what the outcome may be. Now, first thing I have to tell you is I don't know. I absolutely don't know. I've been reading so much content over the last several weeks and, in fact, the last couple of months. And even this past weekend, I spent a considerable amount of time reading the latest data so that I could be as informed as I can be to kind of boil it all down and give you some guidance. I think this is a good map. This comes from 270 to win, which, of course, a candidate needs 270 electoral votes to win the presidency. And so what this chart tells you is there are a number of states that are probably pretty well determined. Dark colors, either blue or red, indicate that that is a state that is likely to cast their electoral votes for the Democrat or president or Republican candidate, respectively. The lighter colors, you get into a likely or a leaning scenario. Again, probably going to go that direction, but not as certain. And then you end up with the 7 swing states that total 93 electoral votes that ultimately are going to determine the outcome of the election and who gets to 270 and how they get there. The bottom line is both Trump and Harris have multiple paths that could lead them to 270 electoral votes. The number one way that Vice President Harris would likely get to 270 is by winning that blue wall. The blue wall being that Wisconsin, Michigan, and Pennsylvania. Those are the three beige color states there at the top of the map, of course. If she wins those, then she's got a pretty darn good chance of ending up with 270. Um, Interestingly, if Trump were to carry the other four, that would be Nevada, Arizona, Georgia, North Carolina, the net result is 270 to 268. Talk about close, but that would be a Harris presidency. By the way, there's a little quirk there. If you look at Nebraska on this map, you'll see four with a little one in a blue square. Nebraska is one of only two states that actually awards their delegates um, based on congressional district. And so the second district seems to be leaning towards Harris, and he would need that one vote out of Nebraska in order to get her to 270. So I don't think that's going to be a critical issue. I think one of these other seven states, but just an interesting data point for you to maybe keep your eye on election night or after. Which, by the way, before I forget, unless you're a real night owl, you may not want to stay up trying to see the results. With the results being defined by these seven swing states, it may be late Tuesday night or early Wednesday morning before we have a clue. And in fact, we may not know on Wednesday morning, depending on how these ballots are being counted. I think when you get initial results out of Pennsylvania, that's going to be a key factor for us to be watching. Now, it is possible that not only could Kamala Harris carry the blue wall, but she could expand on the states that President Biden won 4 years ago. He fell short in North Carolina. That is a state that very much could go her way. If she won all seven, she would win fairly convincingly at 319 to 219. Keep in mind that all of this is in a popular vote context that is a very, very close race. So you kind of see the difference between the electoral result versus the popular result could be radically different. It could be very close, it could be broader. But if Kamala Harris loses Pennsylvania, well, then the picture gets very interesting. And she's going to need to pick up some other states. If she can hold on to Michigan and Wisconsin, and then they split North Carolina and Georgia either way. Just one of the states in the West Coast needs to go her way. Nevada would probably be the most likely. So if you're getting your scorecards ready, those are some states to watch from the Kamala Harris perspective. From the Trump perspective, similarly, if he takes Pennsylvania, that is an incredibly encouraging sign for the Trump camp. Um, Basically, if he won Pennsylvania, then Georgia and North Carolina get into exactly 270 and it's all over before we even get to some of these Western states. But if Harris is able to take one of those two, either Georgia or North Carolina, um, then she would need to take three of the four remaining. So if this is getting convoluted and confusing, that's what this election is all about at this point. I think that a lot of the data that I've been reading just over the last week or so has indicated that there's been a little bit of momentum building in the GOP. We'll see if that continues. One of the things that I think is critically important, I read an article that said, hey, one of the things that was true in the last couple of presidential elections was that the polls did not accurately reflect the support that the Trump candidacy had. Well, the pollsters are aware of that and they've made some adjustments. And so I've heard a lot of commentators saying, yeah, but the polls don't fully capture the support that Trump has. He may actually be much further ahead than is perceived. I'd be a little cautious jumping to that conclusion. It may still be true, but it's hard for me to really know how to interpret the polls given the adjustments that the pollsters have made. Ryan, why don't you flip to the next page? I do want to make a couple quick comments about the race for the Senate. I would actually argue that the race for the Senate and the House are equally as important as the presidential race. We maybe don't hear about that as much, but in the battle for control and how legislation is going to get advanced on a going forward basis, The Senate has 34 seats up for election. 23 of those 34 are currently held by Democrats or independents. So that's why a lot of people have been saying for some time now that the Republicans are likely to take control of the Senate. They just need to flip two seats and or one seat if they win the White House, and then they'd have the tiebreaker with vice president, as the Democrats have now. The current mix is actually 47 Democrats, 49 Republicans, but there are four independents, three of whom typically vote with the Democrat caucus. Therefore, Kamala Harris as vice president has been that tiebreaker that give the Democrats a slight advantage in Senate currently. On the next slide, you'll see the race for the House. And this is where all 435 seats are up for election. You can see that right now you're looking at about 206 Republican, 204 Democrat. If you add up the safe, likely, and leans, that leaves 25 that ultimately are going to determine who has control of the House. Generically, the Republicans have a slight majority now and have had since 2022. Generically, folks have been saying the House is likely to flip just as the Senate is likely to flip, which would leave us with divided government yet again. That having been said, there has been some momentum in the last week or two that the GOP seems to be getting. If that's true, there is the possibility that you could end up with a red sweep. That was thought to be out of reach just a few weeks ago. Again, until all the ballots are counted, we won't know. So, what does all of this mean? If we go to the next page here, we'll begin to look at some data. And so, the first point is it gets back to that volatility comment I made earlier, that it typically rises heading into the election through October and into early November, and then it does begin to fall off after the election. Now, there have been some extenuating circumstances, whether that is the Fed saying, hey, this is what we're going to do, or here's what we're seeing, or maybe some economic data that came out that makes people less convinced the Fed's going to cut rates as quickly as we previously thought. There have been other factors impacting the market, but certainly this uncertainty around the election is a component. Geopolitical events are a factor. I mean, there are a lot of things that impact the markets, as we'll discuss. Ryan, why don't we go ahead and take a look at the next slide? I'm going to pick up the pace just a little bit here. These next few slides really share a picture, tell the story with a picture pretty succinctly. So the point of this slide is that in advance of the election, so over this next week or two, it'll be fascinating to watch what the market does. What you see here is that when an incumbent party lost the election, you see the market begin to move up a little bit more dramatic. You see the market drop in September and October and then begin to pick up a little bit more dramatically in the last few weeks. Whereas if the incumbent party wins, you don't see as much of that weakness in September, October. Key point, this has been accurate about 82% of the time. So 1 out of 5 times, this doesn't work. So interesting, but I wouldn't rush out and make a lot of investment decisions predicated on this chart. The next slide shows you some more data that is interesting. This looks at the 30 days prior to and the 30 days after the election, and it shows the average market return for both a Democrat and a Republican victory. And this comes from research affiliates, and I like what they put on the right half of the screen. Stocks don't seem to care that much who wins. I think there's a bit of a relief that the election has finally come, it's over, and some of that uncertainty has gone away, and the market participants can begin focusing on some of the other fundamental factors once again. If we go to the next slide, this just shows the returns in election years. And so what you should notice immediately is it seems like every time there's an election, the market finds a way to have a positive return. That at least going back to 1956 with an average return of 16.4. We're obviously ahead of that already year to date. And you can also see there's a fairly equal distribution between tall blue bars and tall red bars. I don't know that which party wins has a strong correlation to that performance. On the next page, we look at yet some more data. And this goes all the way back to kind of a World War II era, 1944 going forward. And it just shows how, and this is represented by the S&P 500, by the way, but how the stock market has responded to the various elections, which are represented, of course, by blue and red, a Republican president, Democrat president. The market has found a way to move up in both of those scenarios. So maybe a little bit of encouragement there. Here's some hard data. This is from 1933 through 2022, and it excluded 2001 through 2002 because tech bubble, the attack on 9/11. There's some extenuating circumstances there. But when you look at that stretch of time, you can see that when a Democrat was president and the Democrats controlled House and Senate, the return was 9%. This is the average annual return. For a divided Congress, you get your strongest return at 13.6%. And if the Republicans have control of the House and Senate while there's a Democrat in the White House, 13%. Flip to the other side, there's a Republican president. Again, similar that if the opposing party controls the House and Senate, you experience your lowest return. If it's a divided Congress, you get your highest return. And then if the Republicans have a clean sweep, it's a little bit lower than if you have a divided. So what you might be rooting for, if you believe this data to be the gospel, which I do not, you would say, I don't care who wins the White House, let the House and Senate be divided because that's our best chance for a strong annualized return. That is to assume that the only thing you care about are returns, which obviously is your investment advisor. We certainly do, but there are other factors to take into consideration as it relates to the future of our country. Ryan, go ahead and flip through to the next slide. And I think I'm getting towards the end of what I wanted to share. I'm about to turn it over to Ryan, who can really get into some of the substance of what these policies might mean. But I didn't want to have a conversation with you today where we talk about the election, what might happen, what might not happen, without pointing out the fact that, as I've alluded to, there are a number of other factors that will influence how the market behaves. I would argue that some of these factors are actually more significant than who wins the election from a market perspective. Again, I'm not saying that the race of the White House and the complexion of our Congress isn't important to the future of our country. It absolutely is. I actually was concerned that I might not be in Florida, where I now live, on election day. So I requested and have completed my mail-in ballot. So I've already done my civic duty. I have voted. And I do care about that. However, when you think about the economy and markets, and specifically markets, the strength of the economy or the GDP rate is an important input. You hear us talk about the Fed and interest rate policy. That monetary policy, largely influenced by unemployment and inflation, is another key factor. But there are other factors as well, like innovation. We've been talking about this AI trade for the last year and a half and watching these big tech companies really surge in value. NVIDIA has just become the darling of the stock market because of innovation in artificial intelligence. There's also innovation in biotech and in energy, in areas throughout our economy. And it's one of our blessings as the United States of America that we have a very diverse economy with a lot of different impacts that can impact markets in general. And then, of course, near and dear to my heart, corporate profitability and valuations ultimately have the final say in relation to what the market does. If corporations are improving their profitability and valuations are at or below median, that bodes well. I will admit, we're 2 years into a bull market right now, and the valuations are a little stretched. That doesn't mean the market has to collapse, but that's something to keep an eye on every bit as much as the results of this election. I do have, I think, one other point that I wanted to share with you. Nope, I moved it to the end. So I'll say a few things at the conclusion, but Ryan, why don't you help us understand what all of this could mean for taxes?
Sure. Thank you, Phil. That's a really good data. Still don't know anything more about the future than I knew when this started, but that is really good information, really good data for us to be considering. And I know at least I in particular, as you watch some of the voting results come in on Tuesday night, my eyes are going to be a little bit more focused in a couple other places versus what they might have been otherwise. And thank you for sharing some of that. So those of you that have known me for a while know that I've picked up a little bit of a passion around tax planning, income tax planning for families. And not to say that we don't have that focus as an organization. We absolutely do. That's kind of where I got the interest, was seeing families evolve through time and their tax strategies unfold over time. See how some of those were highly beneficial, with the ability to look rearward at some of those planning decisions that we made all those years ago in coordination with their tax counsel. But looking back is one thing, and looking forward is a completely other thing altogether, right? That it as little as we know about the outcome of the election at this point, we know just as little about where taxes are going to be in future years. So you just kind of keep that in mind as a backdrop to all this, that when it comes to tax planning, one of the greatest challenges that we typically have is we're not playing with all the information. We know what things look like today, but we don't know what they're going to look like in future years, which is why it's important to have an understanding of the various concepts and the various techniques, and ultimately make decisions that give your family the best probability for a positive outcome, knowing that it's not ever going to be absolute. So just kind of wear that in mind as we move through some of this material here today. But one of the things that I first wanted to share, work for you. There we go. Is I always make like a little bit of light about tax before we actually get into the not light subject matter as it relates to income taxes. And that's a little cartoon that's a little pithy in its nature. But it does speak to a nugget of truth that, you know, all political cartoons have that little nugget of truth, which makes them kind of entertaining to look at. But whole commentary being here tells us what we already know. The tax code's complicated. It's not easy to change. It's not easy to fix. Right? It takes literally an act of Congress to make any substantive changes to the tax code. So it's really something that does require a lot of energy. And specifically as it relates to the upcoming elections, you know, you've got both candidates saying all these things that they like to do. And as I'll mention later, I'll share some thought with you on what those things are. But you actually have to get the things into law, which isn't necessarily easy. You actually have to reform the tax code to affect significant change. The other thing I'd point out here is this is not a new cartoon. You may not be able to see it on your screen, but there's a little date down there. This cartoon's actually from 2014. So over a decade later, you know, we're still talking about the same exact thing. And if I wanted to, I could probably go back in time even further and find one from the 80s or the 70s or the 60s or the 40s and 50s that more or less says the same exact thing. You know, the tax code is complicated, and it's really hard to affect significant change. Well, that's relevant for the election because there's a unique aspect to the tax code that we're going to spend a couple of minutes talking about, and Phil mentioned it earlier. That is, the current tax code that we're in right now is set to automatically expire at the end of 2025. So that puts a little additional energy, a little additional charge into the candidates because they're being pressed. You know, what are you going to do in light of the expiring tax code? Before I share some thought on that, I do want to point out, again, I'm not an accountant, Phil's not an accountant. You know, we're just doing our best to share some observations and planning thoughts with you here today. And due to the time constraint and, again, the fact that we're not accountants, we can't possibly cover everything that's in these tax proposals. We can't cover everything that's in the current tax code. We can't cover everything that might happen. So we're going to try to share some high-level thought, some of the big picture type things that could potentially impact you, the families out there, as we talk about your tax planning going forward. So before we talk about what the candidates want to do, it's important to have an understanding of where we are and where we might be going. Let's set the stage, in other words. So when we talk about the Tax Cuts and Jobs Act, that was a piece of legislation that was passed in late 2017 that took effect in 2018. That drove the tax code that we're in currently. Because of the way that it was passed, the Republicans wanted to get it through with a simple majority. It means it had to include an expiration date. As I mentioned before, that expiration date is New Year's Eve 2025. So we've got the rest of this year, we've got next year, but January 1st, 2026 if there are no new bills put into place, no new laws passed, if nobody can agree, the default is going to be the current tax code expires, it evaporates, and we default back to the tax code that we last saw in 2017. It's possible, really, regardless of how the election works out, in all probability, there's going to be some fairly animated negotiations to try to get something worked out before it expires. Again, both candidates have their own ideas of what they want to do, so there's likely to be some energy behind that, which means if you paid attention to the government for your entire lives, you realize nothing really happens quickly, so it's quite possible that we're into 2025, we're into halfway through 2025, we're into the fourth quarter of 2025, and oh, hey, surprise, we came up with some new stuff for you, which leaves very little time to actually do any planning around that if it's going to take effect immediately in 2026, which I believe is the most likely possibility, that we really won't see anything get shaken up too significantly until 2026 at the earliest. So just keep that in mind. So some of those provisions are set to expire, and we may not see those extenders until well into 2025. So let's talk about what we know, that again, without any new laws being passed, what is likely to happen automatically. And the first of which is we'll see a change to the marginal tax rates and the size of those brackets. We'll see a change to the standard deduction. It'll be a reduction of that. There's an elimination of what's called the SALT cap. There's the return of the personal exemptions. You remember those things we used to get? Those may come back. And then there's a special provision that allows some deductibility to pass through business income for qualified businesses. And again, we'll share a little bit more thought about that as we move along here. But that just gives you a general idea of some of the bigger items that are set to be changed or go away when the Tax Cuts and Jobs Act tax environment leaves us. So let's talk about the biggest one, the one that gets the most attention, at least in my opinion, and that is, what's my tax rate going to be? What's my marginal tax rate? And we've got a comparison here that shows you on the left-hand side where the current tax rates are, and the size of those brackets, by the way, is also included here, under the Tax Cuts and Jobs Act that are currently in place for tax year 2024. Over on the right-hand side, what you'll see is assuming it evaporates and goes away and we default back to the 2017 tax code, they'll adjust everything up for inflation most likely, and this is a pretty good bet of what we might see if that does happen. So I'll point out a couple of things here, because most people kind of have this tendency to think that because it's called the Tax Cuts and Jobs Act, they're paying lower taxes now than they were before, which means when it expires, they're going to pay higher taxes than they were before. And while that's certainly true for a lot of individuals under this change, in fact, I'll call specific attention here to the top marginal rate, which is currently 37% on incomes above $731,000 for a married couple filing jointly. Well, that would go up to 39.6 at a much lower level of income, $583,750. So you've got not only a higher rate, but you've got a lower level before you hit that higher rate. But let's look at a couple of examples that show that that isn't necessarily true for everybody everywhere. So I'll give you a hypothetical. So you've got a married couple filing jointly. They've got taxable income, which is $350,000. If you look at your chart here, you see $350,000 puts that couple in the 24% tax bracket. Great. If we transition to the pre-Tax Cuts and Jobs Act tax code and you just kind of move directly over to the right, you might think, all right, I'll go from the 24 to the 28. You would be wrong. If you look at where $350,000 falls under the bracket size, it actually moves down on your screen a little bit lower, which is into a higher bracket. So that same couple with that same $350,000 of taxable income has an increase in marginal tax rate from 24 cents up to 33 cents on the dollar. So a 9% increase, which is a substantial move. That family's likely to feel that. But to give you another example, that isn't true everywhere. So consider a single filer with taxable income of $200,000. That individual would be in the 32% bracket currently. But under the new code, that would change, and they would actually drop down a bracket to the 28. So depending on who you are and what your income looks like, you might have a higher rate on that marginal income. You might have a lower rate on that marginal income. But the taxable income, which is what we're looking at here, is only part of the story. Taxable income, very, very generically speaking here, is your gross income less your deductions and other income reductions, okay? And that is actually how your marginal tax rates, the tax that you actually pay, is calculated. Well, the Tax Cuts and Jobs Act had a number of impacts that changed the math, a number of different rules that affected your level of taxable income. So before you ever get to the brackets and your marginal rate that we saw in the previous slide, you got to calculate that taxable income. Well, there's some things in the Tax Cuts and Jobs Act, as I said, that might change that. One of the more notable ones is the reduction in the standard deduction. I think a lot of people have already forgotten how many people itemized in the past and how most people, especially if you have a mortgage or if you donate to charity in any significant degree, there was a number of other deductions. If you've got some of these deductions, most people found themselves itemizing. Well, the Tax Cuts and Jobs Act was designed to be a simplification of the tax code. You may remember there was commentary that you'd be able to file your taxes on a postcard. They're right, that didn't happen, but it illustrates the idea that things are supposed to be a little more simplified. And a larger standard deduction does do that because you don't have to keep track of all those receipts and all those other little things that you used to have to watch because you just took the standard deduction because it's so much larger anyway. Well, if the Tax Cuts and Jobs Act goes away on us, that would be reduced from its current level of $29,200 for a married couple down to, the best guess would be about $15,000, $16,000, somewhere in there. So just by default, you'll have a higher taxable income because you'll have a lower standard deduction, which means if you're a family that doesn't have a whole lot of deductions to begin with, you might actually see that higher taxable income because of the lower standard deduction. But in addition to that, as if that weren't enough, there's also some changes to the itemized deductions themselves, how that deduction total was actually calculated. The first of which is kind of a big one for some people, especially if you're a high earner in one of the high income states out there, high income tax states out there. This elimination of the SALT cap is kind of a big deal. So SALT just stands for state and local taxes, and it's just kind of generally your state income tax, your real estate tax, your personal property tax. There's some other ones in there if you've got a city tax, that sort of thing. But right now, under the current code, regardless of how much you pay in those taxes, you don't get to deduct more than $10,000 on your federal tax return. Well, that would theoretically go away if the Tax Cuts and Jobs Act expires. There also used to be miscellaneous deductions. There was a whole bunch of those little things. None of them were huge deal. One of those would be conveniently investment advisory expenses, which you used to be able to deduct. That whole entire category, by and large, went away. That would theoretically come back. Currently, there's a cap on the size of a mortgage loan that can be deductible. It's $750,000. That would theoretically go back to $1 million. And then while the deductibility of the charitable giving strategies themselves wouldn't necessarily change, the actual, I'd say the deductibility would change, the actual strategies would. Again, with a much lower standard deduction, it would be much easier to get a tax benefit from the charitable giving that families do. You would see potentially less what we call lumping and clumping, where you accelerate multiple years of charitable giving into a single tax year to try to get some additional tax benefit from that. So you can see some changes there as well. And I realize here I'm gonna have to pick up the pace just a little bit if we want to actually hit the end of this thing, and I could go off on a number of different directions on taxes. So I'm gonna speed up just a little bit here. We would see a return of the personal exemptions that I mentioned before, estimated to be around $5,000 per taxpayer. So maybe husband, wife, and then dependents, both children and adult dependents as well would be included there. So if you've got 15 kids, that's really good news for you. If you don't have any kids, it's not going to help you quite as much. But theoretically, that would be a reduction in income for a lot of taxpayers. And then I mentioned before, there's a special provision that allows an up to 20% deduction on qualified business income for pass-through entities, think S corporations, partnerships, sole proprietorships. That would potentially go away. So while I spent more time on that probably than I should have, I think it is important to have a good understanding of the current tax environment because it could be highly informative of where we might go. Remember, as Phil talked before, we've got such a tight race, not just for the presidency, but the congressional races are close, which means that in order for significant reform to be passed, it's got to be a pretty hard swing one direction or the other. And if that doesn't happen, you're kind of stuck with the status quo. We're going to default to that tax code, and we'll default to the expiration of the current tax code, and you'll see a lot of those changes that I just mentioned. So while we're talking about nothing that's related to the candidates in terms of that particular aspect, it's important to understand that's our default. Unless something else happens, that's where we're going to land. So we'll share a little bit about what the various candidates would like to try to accomplish in terms of their own tax proposals. Remember, these are words on a campaign trail. You know, it's one thing to say things in a speech, to actually turn that into something that you can get accomplished during your term, complete different animal altogether. But let's talk about it anyway. So one of the things Trump would like to do is make permanent the Tax Cuts and Jobs Act. So effectively carry everything that I just described. I spent all that time walking through. You just keep it carried forward, kind of keep the status quo. Nothing expires, nothing goes away, with one exception. But before I mention that, it's important to note that that would include the estate tax changes that we saw in the Tax Cuts and Jobs Act. Now, I haven't mentioned anything about that yet, but I will in a later slide, so I'll get to that. Of note, though, he would like to eliminate the salt cap. I think the quote was "get salt back." We think that's what he means, is that cap, that $10,000 cap on the state and local taxes would go away, but everything else in the Tax Cuts and Jobs Act would continue. You'd have a reduction in corporate tax rates, primarily focused on domestic production. There would be some incentives that do that, in addition to incentives to further R&D, bonus depreciation, a lot of classic examples of tax incentives for businesses to expand operations and invest in their entity. No tax on tips, overtime, or Social Security benefits. You could argue is that really going to move the needle for a lot of people and just introduce some additional complexity? Yeah, probably, but create a deduction for auto loan interest, which I think is very, very interesting. In terms of how you're going to pay for some of these changes, well, there's been talk about repealing some of the green energy credits that were put into place through the Inflation Reduction Act, or IRA. Those were temporary in nature anyway, but a more near-term repeal of those would help to offset some of the cost. But most notably, and I would maybe argue most divisive, is the potential to impose new tariffs on imported goods in the United States. And this has covered a range through various speeches, but there's been talk about a 20% universal tariff, maybe 60% on incoming goods for China, which there's a lot of questions about. I get the thought behind that, get production, get activity back here to the U.S., but would it really work in the way that it's been laid out? It's possible that it would actually serve to increase prices. That could be hard on lower income families. Would he even be able to get it passed? Would there even be enough support, even with a Republican sweep? Would he be able to get enough support to get something pushed through like that? That's a consideration. There's always the potential for retaliation, trade war, which is really something nobody wants. So while that's an important part of offsetting some of the costs associated with some of his proposals, would it work and could it work are a couple of questions that would need to be answered. And on the Harris side of things, quite a bit of a different take. I'll start with one small similarity, and that is there's been some talk about extending the Tax Cuts and Jobs Act, but only for those with incomes of $400,000 or less, which probably sounds familiar. That's kind of been the Biden rhetoric for a long time. We're either reducing or no higher taxes for families with under $400,000 of income. But along with that would be an increase in the corporate tax rate, an increase in the top marginal rate, which we saw is going to happen anyway if the Tax Cuts and Jobs Act expired. But that's the thought there. Higher tax on capitals and capital gains and dividends. That would go to 28%, but only on those with $1 million or more of taxable income. So really focused on the wealthy there. A tax on unrealized gains for some taxpayers. There's been talk of this minimum billionaires tax of 25% on unrealized gains. There's been talk about taxing at the estate. Right now, there's a cost basis step up. There's been talk about eliminating that and having tax on unrealized gains in excess of $10 million for families. An expansion of the net investment income tax that would now include passive business income, and also an increase in that rate from 3.8, where it is currently, up to 5%. You're probably picking up on a little bit of a theme here: higher taxes for businesses, higher taxes for the wealthy. There's been no secret about that if you've seen any of the campaign commercials. That's really the goal here. There's been some talk of limiting retirement contributions. If your accounts are too large, you make too much money. There's also been talk about, I like that idea about no tax on tips, so might as well throw that in here too. And then So a lot of that additional tax revenue would be redirected to kind of special purposes, expansion of the child tax credit that's in place, the earned income tax credits in place, special tax credits for first-time home buyers. There's the America Forward, which kind of focuses some incentives and credits on certain specific industries. So a number of different what I would probably consider kind of wealth redistribution type maneuvers here to try to shift some more to the middle class. And that's really been the foundation for the Harris commercials, at least that I've seen, really a focus on the middle class. Whether or not these things would be, again, executable or would achieve their ends, complete different discussion. We'll talk about that on a different day. We just don't have time to get into that today. But again, that's a summation of the highlights associated with the various candidates' proposals. So what are you going to do with that information? What can we actually accomplish since so little is knowable at this point? Well, we're going to pay attention, right? We're going to watch how things unfold. We're going to see the outcome from the election. That'll be known relatively soon. That's going to provide our first clue. But I'm going to take a step back from what might happen in the election, what might happen in 2026. Will the Tax Cuts and Jobs Act expire? I think it makes sense to take a bigger picture view and really think about what I consider to be one of the greater sources of frustration up until this point. And that is that neither candidate seems interested in addressing the other side of the equation, the deficit spending, the national debt. Sooner or later, that's going to have to be addressed. I looked earlier today, and I need to really stop doing this. It's up 35.77 trillion as of today. And as we talk about all these measures that would cut tax for some and provide credits for others, and great, but somebody's going to have to figure out a way to address the national debt. That's really a big issue that's kind of being ignored up to this point. And the reason why that's relevant here is that there's some concern that in future years, the current tax rates that we've been enjoying, and I say enjoying because from a historical perspective, they're fairly accommodative, may not be as accommodative in future years beyond our near-term view. So it's good to understand what the backdrop is. What do things look like near-term as well as longer-term? And I haven't found an accountant yet that's been willing to tell me he or she thinks taxes are going to be lower 5 or 6 years from now. I haven't found one yet that said that. So that's kind of the backdrop to all this, is the thought that taxes may be higher for a lot of people in the future. So you have to think about what planning techniques might make sense at the family level now, while acknowledging that it's going to be different for everybody. Everybody's got their set of different circumstances, younger, older, working, retired, high levels of wealth, low levels of wealth. Everybody's got their own set of circumstances. So you have to look at it on a case-by-case basis. But by and large, what we're talking about, is it better for you to pay tax now or wait and pay tax in the future? If you think you're going to have a lower tax rate in the future, it might make sense to defer some of that income. If you think the taxes are going to go up, it could make sense for you to consider accelerating some of that income, pay the tax now. And that's something that should be done annually. Yeah, I mean, most of you know that by now. We have our tax discussions towards the end of the year. That's a big part of what we do. And as the rules get known and as these deadlines and expirations get closer, it's going to amplify that planning process. But the goal is still the same. It's not to pay the least amount of tax this year. It's to pay the least amount of tax over your lifetime. I'm really going to have to fly through this because I know we're getting short on time here, but up until this point, I've talked exclusively about income tax, but I'd like to spend just a minute or two talking about estate tax, because that does have the potential to significantly impact some families. And that is relevant because of the expiration of the Tax Cuts and Jobs Act is likely to reduce the lifetime estate tax exclusion, which again, very simply is just anything below the lifetime estate tax exclusion. There's no estate tax to that family at death. Anything above that would be subject to estate tax. Right now, that lifetime estate tax exclusion is 13.61 million. That's per person, so roughly 27 million for a married couple. That's probably, if things go the way that they're looking right now, going to be cut in half by 2026. So you've got some families that don't have an estate tax challenge now that might immediately, just as soon as we wake up January 1st on New Year's Day 2026. So it's important for those families to consider some planning strategies that might make sense. Portability, if you've lost a husband or wife passes, the survivor can elect to claim portability, which is really just kind of locking in the deceased spouse's larger lifetime exclusion, even if you don't need it yet. Irrevocable trust creation and funding. That's just moving assets outside your state, utilizing some of your lifetime exclusion, but then getting some growth outside of the estate. Annual family giving, that's $18,000 you can give per person. So a husband or wife could give each of their kids $36,000, for example. That's without having to report any of that. So that's a way to reduce the size of that estate. Roth conversions are useful, not only from an income tax perspective, because you get a lot of tax-free growth, but when you pay the tax, you reduce the size of your estate, and that can help if you've got a state tax liability as well. And then, of course, money left to charity if the estate is not subject to state tax. So that's something some of those families do. The most important thing I'll share there is if you think you might be impacted by any of what I just talked about, if you think you might have a taxable estate, don't wait until the fourth quarter of next year to try to do something about it. You might get a rude awakening when you call a state attorney and said, yeah, there's no way we're getting that done before the end of the year. It takes time to affect these strategies. So don't wait till the last minute. And I'm pretty well out of breath right now. So I'm going to go ahead and let Phil go ahead and share a couple of parting thoughts here. You're muted, Phil.
Appreciate everything you just shared, Ryan. While you were delivering that information, we did get a question about specifically tariffs. And should we expect tariffs, if implemented as Trump is proposing, to have a similar impact to what they had in the 20s as a lead up to the Great Depression? And so the Smoot-Hawley Tariff Act of 1930 did, by all accounts, worsen the Great Depression by reducing international trade and weakening the U.S. economy. Global trade plummeted, etc. What would happen if Trump got 20% tariffs on goods and 60% on imports from China? It would probably be inflationary. The general consensus is that there would be a pass-through of those costs to consumers, that it would likely reduce the after-tax income for just about all Americans. And so there would be negative factors. However, I saw an interesting video that suggested that is looking at the impact of the tariffs in a bit of a vacuum. And the thing that we don't know, that I haven't heard a lot of people talk about, uh, do you recognize that a lot of our exports are assessed tariffs by the countries we're exporting to? And so at least one economist posited if we were to impose tariffs, it would likely open a whole new wave of negotiation about the tariffs on goods that we export. And if there were a productive negotiation at that point, it could end up being more of a positive. That's a lot of ifs. I think it's a risky move, in my opinion. This is just my opinion. Knowing the harm that tariffs have done historically, I'm apprehensive. But when you think about the offset, that maybe we end up with truer free trade where our goods are more readily accessible by people around the world, that's interesting. I do think there's a fundamental difference between our economy today and the economy that existed in the 20s and 30s. We were much more independent then. We are much more reliant on global trade today. I want to say we import about $3.1 trillion of goods annually. So that's not a small element to be moving the needle on. Ryan, would you have anything that you would add to that?
No, it's I have the same concern that you have around, anytime you try to artificially manipulate free trade, it has the potential to lead to a less than optimal outcome. But it's possible, is this a negotiation tactic that does lead us to a stronger position? There was a lot of commentary around that the first time when we were talking about Trump tariffs, you may remember, and the potential for trade war that didn't really happen. It could just be, we want to negotiate from a position of strength, and this is just Trump being Trump, and that's just where he's going to start. But we wouldn't actually see those. But again, I'm until I see otherwise, I'm likely to always be a little bit leery of artificial manipulation of free markets. I just generally don't like that in concept.
Well said, Ryan. If anybody has any other questions, feel free to enter them in that Q&A chat box that Ryan mentioned at the beginning. I'm going to share just a couple of key takeaways for today. Number one, and this is where I get to mix in a healthy dose of opinion from Phil. There's an economics and public policy professor at Wharton who said both candidates' plans will do two things. Number one, increase the national debt, which, as Ryan mentioned, we're somewhere just above $35 trillion right now, and simultaneously reduce the size of the economy. That's not an awesome combination from my perspective. Now, again, that's predicated on their plans. And as Ryan suggested, what a candidate says on the campaign trail and what they actually get accomplished once they're in office are oftentimes very, very different. So, we'll have to wait and see who wins, what the mix is. And the other thing that I would share is even if either party had a clean sweep, White House, House, Senate, it is likely that the majority they would have in the House and the Senate would be fairly narrow. And as we've seen over the last 10 years, a narrow majority in the House or the Senate can limit what the party in power is able to do, because what we've seen on both sides of the aisle is that there is not unanimity across either party. There are a lot of factions within each party, and you can have centers that go, I'm not going to vote for that. And so you really need to see these parties get, I think, a little bit more of a majority in order to pass substantive legislation. Otherwise, they have to placate some of the fringe element that maybe is a little bit more moderate than maybe the core piece of legislation being considered. The other thing that I wanted to share with you is, this is a contentious election, and there's no doubt that it could have an impact on taxes, as Ryan was talking about. It also could have an impact on Social Security. It could have an impact on healthcare policies. The thing that I'd leave you with is we probably need to be a little bit careful making critical decisions about what might happen before we actually know what does happen. It would be easy to overreact in some ways and perhaps do more harm than good. And we want to be careful not to do that. Over the years, I've been doing this for a couple decades now, and I've watched our wealth management strategies at Brand Asset Management Group evolve over that time, influenced by new learnings, influenced by changes in law. And so as the environment that we operate in changes due to the election and new policies that come from whoever the victors are, we will revisit our strategies and we'll be talking to each of you in our meetings about, hey, this has been an effective strategy for you, but under this new scenario, we think we need to adjust it in the following ways. So we're rolling up our sleeves and ready to get to work to evaluate what comes out of this election. And Ryan did a nice job of kind of painting a picture, at least on the tax front and on the estate front. We've got a pretty good idea of what could happen. And as we get better clarity coming out of the election, we'll begin to talk to you about some different strategies. We have gone over time by just a couple of minutes. I don't see any other questions in the Q&A at this point. I will thank each of you for joining us this afternoon. We hope you found something of value in this. We take it as an honor that you allow us to serve you and that you have devoted the last 60 minutes to listen to Ryan and I share some thoughts. As he said at the very beginning, if you have questions about your specific situation, certainly feel free to call our office or drop us an email, and one of our advisors would be happy to talk to you about your specific circumstances. With that, I think we'll wrap it up. Ryan, any parting comments?
No, not that's going to prove what you just said. Well, I will share my kind of my static piece of advice. It's real easy to get hung up on all the things that you hear about and you read about, all the things that may or may not happen, and you lose sleep over them and you worry about them. But focus on what's important. Focus on what you can control. Get out there, vote. Do your civic duty that Phil already did. Cast your vote. But try not to get worried about too much about things that may or may not happen. If they become law, we'll figure out the best path going forward. Try not to have too much heartburn before it.